Welcome back to the channel. Today we're diving into one of the most debated topics in investing: dollar cost averaging versus lump sum investing. When it comes to putting money into the market, which approach is better? Let's break down the key differences and factors to consider so you can decide which strategy is right for your situation. First, let's define the two approaches in more detail. Dollar cost averaging is an investment strategy where you invest a fixed dollar amount on a regular schedule, regardless of share price. It involves spreading out investments over regular intervals, regardless of market fluctuations. This method seeks to alleviate the stress of market timing, allowing investors to purchase more shares when prices are lower and fewer when they are higher. For example, you may invest $100 every month or $500 every quarter. Over time, you end up buying more shares when prices are low and fewer shares when prices are high. This helps lower your average cost per share. The benefits of dollar cost averaging include reducing volatility risk and avoiding putting all your money in at once right before a downturn. It also forces discipline by requiring regular investments. However, the downside is it does not take full advantage of market ups since your money is not fully invested. Lump sum investing means putting in all your available cash for investment in one transaction rather than spreading it out over time. Lump sum investing involves deploying a significant amount of capital all at once, banking on the potential for higher returns from immediate market exposure. For example, if you have $10,000 to invest, you would invest the full amount immediately rather than dollar cost averaging it in over several months. The benefit of lump sum is that it allows your full investment to start growing and benefiting from compound returns right away. Historically, lump sum outperforms dollar cost averaging about 2/3 of the time because the overall stock market trend is usually upward over the long run. You want your money invested and compounding as soon as possible to maximize returns. However, the risk is that you could put in a lump sum right before a downturn. This subjects your entire investment to short-term volatility, and you may have to wait years to recover losses if you sell during the dip. So in summary, dollar cost averaging spreads out your risk by slowly investing over time, while lump sum gets your money working for you faster but subjects it to short-term volatility. But why is it important to be able to differentiate between the two? Let's go over two reasons. Diversification of risk. Understanding these strategies is crucial for investors seeking to diversify their risk exposure. DCA offers a shield against market volatility, smoothing the impact of market downturns by spreading investments across time. Meanwhile, lump sum investing requires confidence in timing the market for optimal returns. Psychological comfort. The importance also lies in aligning these strategies with an investor's psychological comfort. DCA often provides peace of mind, relieving the stress of market timing and allowing a disciplined, gradual investment approach. Lump sum investing appeals to those ready to capitalize on immediate market opportunities. Now let's dive deeper into some key factors to consider when deciding which approach is better for your situation. Time horizon. Research shows lump sum generally wins out for longer time periods of 10+ years when you have time to ride out short-term volatility. Over decades, the market has always trended up, so your lump sum has time to recover from any downturns and benefit from compounding. However, for shorter timelines of 5 years or less, dollar cost averaging may be preferable to avoid losses you may not have time to recover from. Risk tolerance. If short-term market swings and the possibility of a 10–20% immediate drop in the value of your lump sum investment keep you up at night, dollar cost averaging will help you sleep better. However, your overall returns may be slightly lower compared to lump sum. Lump sum is best if you have the stomach to withstand volatility. Available funds. If you have a large windfall like an inheritance or bonus, putting it all in immediately as a lump sum makes sense to maximize returns. But if you only have regular savings from each paycheck, dollar cost averaging is a good way to invest what you can each period. Market conditions. If we just experienced a bear market and stocks feel overdue for a pullback, dollar cost averaging spreads your entry points out and avoids putting everything in at a potential top. However, if we're in a sustained bull market, lump sum gets your money invested faster. Fees. Some brokers charge trading fees each time you purchase shares. For small frequent purchases with dollar cost averaging, these fees can eat into your returns over time. Lump sum avoids multiple fees. So in summary, both approaches have merits depending on your individual risk tolerance, timeline, and available funds. A hybrid approach using both lump sum and dollar cost averaging may provide the best of both worlds. Put 50% of your funds in immediately as a lump sum. Then dollar cost average the remaining 50% over 6-12 months. The key is avoiding market timing by getting invested consistently through contributions and not panicking over short-term fluctuations. Sticking to your long-term investment invested consistently through contributions and not panicking over short-term fluctuations. Sticking to your long-term investment plan through all market cycles will serve you best. Analyzing your personal situation against the factors discussed can help you determine the optimal strategy. Ultimately, the decision between dollar cost averaging and lump sum investing depends on your financial goals, risk tolerance, and the specific circumstances you're in. Take your time to evaluate both methods and consider consulting a financial advisor to make an informed choice. Your investment journey is unique to you, and it's crucial to find an approach that aligns with your objectives. If you found this video helpful, don't forget to like, share, and subscribe for more insightful financial content to support your investment decisions.